friends. Good evening, friends. I'm Karan Joshi. I'm a technical and derivative analyst by profession, and I've been trading and investing in the markets for 2 decades now. So, in today's session, we are going to discuss about REITs, and we do have a presentation. So, I'm going to share that with you all, and let's just discuss this. So I hope all of you are able to see my screen. Can I get a confirmation regarding that? Yep, great. So you can see my screen over here. All right. So friends, real estate investments, physical and digital property wealth, right? So our agenda is to discuss the tools, platforms, and a portfolio strategy. We must have an overview of real estate as an asset class. Right, types of physical real estate investments. We will discuss this. We will discuss digital and fractional ownership models. Understand the risks, returns, and risks that we take in financing these. So apart from the PPT, friends, owning real estate is uh, is a lifelong dream of every individual. Okay, not just in India, anywhere in the world. It gives you a sense of security. It gives you a sense of achievement as well. I mean, when an individual manages to purchase their own home or an office space, it is an announcement to the world that they have arrived, right? That they have proved something. So it's a big deal, and you'll find many advertisement campaigns of banks and loan providing companies. They will be focusing a lot on housing loan, because that's the real dream. Even I remember LIC Housing's campaign used to say that हर घर का एक सपना होता है, हर सपने में एक घर होता है, like that. So even from investment point of view, real estate makes a lot of sense, and let us explore that in depth now. So why every Indian's number one dream is owning a property? Because it gives you a sense of comfort, a security. If you are living in your own home, you have a better chance of facing the rough patch of your career, and it's an asset which you are going to pass on to the next generations as well, right? So that's a major plus point that owning a property gives you. Billionaires, 60% or more than 60% of Indian billionaires have made their wealth in real estate, right? If you take a look at all the major industrialists that India has seen since independence, the Tatas, the Birlas, the Godrej family, even the Reliance Group, you'll see that all of them have amassed a huge land bank, and the valuation of those land, that plot itself, has increased multifold over the years. So not just their business, the land on which the business is standing, the land on which the factory or the manufacturing plant is standing, that land itself has appreciated a lot over the years. If you talk about crazy real estate facts, friends, And property rates in Mumbai, they keep changing over a wide range. I mean, I was searching a little bit about this, and Mumbai rates are anywhere between 20,000 per square foot to 80, 90,000 per square foot. Okay, that is an absurdly high amount of money to be paying for such a small piece of real estate, but that's the reality in today's market, friends. In Bangalore, the rentals are booming up. Mumbai rentals are obviously going to be much higher than any other city of India. But over the last decade or so, Bangalore and Hyderabad have boomed quite well. Even a 2 BHK, two bedroom hall kitchen apartment in Bangalore in one of the better areas would cost you between 35 to 55,000 per month. Okay, that's the rent I'm talking about. Even Hyderabad has given great appreciation over the years. So, real estate has been a success story no matter which part of the country you are residing in. Okay, it's been an overall success story. We cannot say the same thing about equities, friends. Stock market performance tends to fluctuate. It can give you great returns in a bull market. So if you see the returns from 2020 to 2024, they were fantastic. But if you compare the returns of 2014 to 2020, then they were dismal. You can say they were even negative. All right. So timing that is very important, and I believe everyone might not have that skill. Whereas real estate is something which has given good returns across India, right? So that's a major advantage for real estate. Another thing you need to know that now you don't need crores to start investing. Why should we consider real estate for long term wealth? Well, it is considered one of the safest and strongest building tools over decades. It acts as an hedge for inflation. Property values and rents rise with living costs. It gives stable, predictable income through rent. It is less volatile. I would say there is no volatility at all in real estate. The prices either remain steady or they keep rising. In my career, I have not seen prices fall in an alarming manner. A 5 to 10% fluctuation can happen anytime, but it's not like equities wherein the assets value drops by 50, 60% in a bear market. That doesn't happen in real estate, right? And here we have the dual engine of wealth creation, friends. We get appreciation as well as rental income. So that becomes very important for us when we retire. Okay, at a later stage of our careers, this income will be extremely helpful. Rental income. So that is something that's missing from our investments in gold or in equities. The rental part. It's something you only get in real estate. The leverage point is very important, and you must study about this in depth, friends. Generally people in India just feel afraid that the now the price of the assets has gone into crores of rupees, and how will we afford it with our little savings and all that. Friends, you have bank loans available to assist you buy that big asset, right? If you have built your IT files properly, that bank loan will help you buy your dream home or your dream office. So do read in detail about loans, how they will help you, friends. That will, I believe, once you gain proper knowledge about any topic, your fear reduces. Generally, I've seen people are just afraid of taking big loans, but you must understand that here the loan that you're taking is to create an asset, and that in itself is a very big thing. So friends, if you have any questions for me, please keep asking the questions. Okay. Yeah, if you have any questions you can just post it in the chat. I'll read it out after each slide and I'll try to answer those queries. Fact is that 90% of millionaires globally have real estate as a core part of their wealth. Right, I agree to it. I've seen hundreds of cases of people, successful people around me, whose net worth is, I would say, 80% into real estate and the rest is into stocks and jewelry and all that. Mainly it is real estate because it helps them generate rental income, plus there's appreciation with the passage of time as well. So it's a plus point. Next question, next slide. We move to the next slide, which says that how real estate actually makes you rich. It provides you passive income via rentals, friends, which means you yourself don't need to monitor your investment constantly. You continue with your 9 to 5 job, or you're in businessman, you continue with your business, and your investments, that's your property which you given on rent, it will keep doing its magic as well. So that's passive income, friends, wherein you yourself are not putting in any extra effort to make that income. It is now running on autopilot mode. So we have many appreciation stories like Bangalore, Hyderabad, the 5x effect, leverage using home loans. Okay, so over here we are talking about how we can buy an asset that is at a price, 5 times more than what we currently can afford to buy. This is where your housing, your loan, be it housing loan or office loan, will help you out, friends. That when you take a loan, okay, don't get scared about the interest that you will have to pay over the years. Just think of it as you are locking the price, that you bought the home, bought the office at a particular price, and you are just going to pay back that amount plus its interest. Okay, with the passage of time, an asset's value tends to appreciate. So you don't have to, compensate for that appreciation. Rather, you can enjoy that appreciation. mean, if you just rent out that asset of yours, that property of yours, it will start generating rental yield for you. Rental in passive income, which you can use to pay off your loan quickly. All right. So never be afraid of taking a loan, at least when it comes to real estate. So people who have understood this concept properly, the 5x effect, they tend to keep adding asset after asset. That once one property is cleared, they end up acquiring another one, end up taking another loan. Because as a professional, friends, as you grow career wise, your income is going to rise as well. Along with that, your asset is getting appreciated. Basically, its value is increasing, and based on the increase in its value, the rental yield is also going to rise. So it becomes a win-win situation for you, right? So you do need to plan how you're going to repay your loan, but it's not something to be afraid of. Fact, real estate is one of the only asset classes that pays you while it grows in value. That is absolutely correct, friends. And home, which was worth a few lakhs, I mean, if you are from Mumbai, a home which was worth a few lakhs 20 years ago is now worth crores of rupees. Over the last 20 years, it has appreciated so much, and now its rental yield itself has gained so much. So, a person who would have bought it on loan, by now their loan is finished, the value of the asset has increased multifold, and now, or rather, over the years, they've enjoyed the rental yield itself, and that yield, that rental income is going to continue. Okay, it's not going to pause, it's going to continue. And you may also benefit from redevelopment, friends. I mean, the smaller cities and towns might not be as acquainted with this concept, but metro cities are seeing a boom in redevelopment, wherein older buildings which are more than 30 years old, they are now getting redeveloped. Normally, you get anywhere between 25 to 35% extra what do you say, space on redevelopment. So that itself is a big appreciation for you. Now the new rentals that you'll get after your asset has been redeveloped, that itself will go up. It's a new construction, so the value of the asset itself has gone up, plus it is bigger in size, so your returns are increasing exponentially over there. Okay, so do keep reading about real estate and the opportunities that it provides you. The four pillars of real estate wealth: one is cash flow, monthly rental income or dividends, appreciation, that's increasing in your property value, leverage, using loans to buy larger assets that grow in value, tax efficiency, home in loan, interest loan benefits, depreciation, capital gain strategies. All of this are very helpful to us. So let us understand them, friends. Let's talk about leveraging. Let's take my example. Okay, the last 4 to 5 years were very good for the stock market. I decided to cash in on that. Basically, I ended up booking profit on my investments in shares, and I took a home loan, a small amount, a loan, and part of the payment I did through the capital gains that I did in my stock market investments. So from taxation point of view, my capital gains got adjusted, right? Capital gains are fully adjusted against the new office that I've bought, and now I do have a loan on that. So when I'm repaying that interest, it is getting set off against my income as well. Okay. Normally, a person who would be booking just profits in the stock market, they would be taxed on the returns that they've made. Now, in my case, it just got set off against. I sold one asset, and against that, I've created another asset. So, tax wise as well, it makes a lot of sense. And basically, you've locked the price of the asset that you are just going to pay so and so amount plus the interest. Now, if the asset keeps appreciating, if it gets redeveloped in the future, all those are your gains. You don't have to pay anything extra for that. So, do read about this a lot, friends, how efficiently you can manage your taxation with the help of real estate investments. So residential real estate, it means properties meant for living like apartments, villas or rental homes as investment assets. They are ideal for long-term appreciation, suitable for beginners due to lower ticket size. They work well in job-driven urban centers. Types would be apartments, villas, studios, student housing, right? And key wealth drivers, the location, the demand, tenant profile, amenities. So these are non-commercial properties that you are investing in, mainly being purchased for self-occupying. But at a later stage, if you do end up moving to a bigger property, then you can use this one to create rental income as well. The last point, the fact, in most major cities, property values doubles every 7 to 12 years during growth phases. Okay, during growth phases, your assets value can double. Even if we take the higher side, let's say 12 years, that itself is fantastic returns. Okay, let us understand the limitations as well, friends. Okay, it's not that there are no minus points about owning real estate. There will obviously be some limitations. So, the strengths and weaknesses, pros and cons means the strengths and weaknesses of buying property as an investment. Pros, it is easy to find and purchase. There's high demand ensures long-term occupancy and strong appreciation in tier 1 and tier 2 cities. So over here, your location would matter. Okay, although we've posted this point, high demand, it's mainly about, we are talking about a prime location, right? If you're living in the outskirts, then probably the demand would not be that great. Cons, residential property would give you a low rental yield. By low yield, we are talking about up to 3% yield. Okay, so that comes to what, 0.25% per month To simplify this, what we are trying to say is, if your assets value, if your home's value is 1 crore rupees, you're expecting a monthly rental of 25,000. Okay, 20,000, 25,000 into 12 gives you 3 lakh rupees annually, right? That's 3% of 1 crore. This is how we calculate rental yield, that based on the current value of my asset, how much return am I getting over a period of 12 months. So, real estate across India has given a 3%, a consistent 2.5 to 3% yield, right? So, that's the story throughout India. And there's high maintenance cost as well, friends. Your structure will get old with the passage of time, so there will be some renovation work required, some plumbing work required. All of this are going to cost you money. And it's not necessary that your asset will always be on rent. Like I said, it all depends on the location. Maybe in a prime area, yes, it would always be occupied. But if it is in a non prime area or far off the city center, in that case, it may happen that there could be a few months in which your asset is lying vacant. Okay, basically, it's not giving you any yield for that particular period. So that is the ground reality which we must understand, friends. All right. So do keep that in mind. Commercial real estate. Now, in commercial real estate, property, we are talking about properties used for business operations, like the office that I just mentioned that I bought recently. Okay, we are basically a premise that you are using for business operations. It could be a shop, an office, a warehouse. All of these can generate income for you. So, higher rental yields. Commercial real estate generally gives around 6 to 10% rental yields. The leases in commercial properties is generally on the higher side, long term leases up to 9 years. They are ideal for stable monthly income. Okay, 9%. I mean, this is what I've managed to gather through my sources in Mumbai, that the rental yields in commercial real estate are around 9% annually. So that's 0.75% per month. To simplify this, if the value of a shop is 1 crore rupees, you are expecting a monthly rent of 75,000 rupees on it. Okay, which means annually you are expecting 9 lakh rupees rental income. That is 9% of 1 crore. That's your commercial real estate, friends. Depending upon the location and what kind of projects are coming up in nearby vicinity, the rates may change. Okay, but commercial estate would be costlier to buy as well. It's not just that the yield is high, the area that you'll get in commercial would be less. I mean, if you had to invest 1 crore rupees in a residential project, you'll probably get a bigger property. Whereas in commercial, with 1 crore, you'll get a smaller shop or something. So, benefits and risks of commercial real estate: benefits, high rental income, corporate tenants would offer stability, You built in rent escalations every 3 years. Basically, your contract itself has a clause that after 3 years, the rental will be increased by 3% or 7% as per your negotiations with your client. So these are the plus points that once it's on rent, you don't really have to worry about the next. If it's long lease, then about up to the next 9 years. Risks wise, it's a high initial investment. Vacancy can significantly reduce income, and commercial properties are sensitive to economic cycles. Basically, if it's a showroom and that brand is struggling, there is a risk that it might shut down. So there can be an interim period where your asset lies vacant, where it's not giving you any returns at all. Okay, then we move on to land investments, buying raw land or plots to benefit mainly from future appreciation. They give you the highest capital growth potential among all real estate types, but there's no rental income. Remember that there's no rental income, but you get long term appreciation. Now, lands could be agricultural, residential plots, industrial land. Depending upon your state, there might be some restrictions. I mean, in some states, agricultural land cannot be bought by non farmers. So, it depends. This is ideal for generational wealth creation, friends. The appreciation would be the highest in land, okay, but it does not give you any yield. As far as land investment is concerned, we do have some strategies. Basically, you can buy near future infrastructure projects. Like if a metro is coming up, generally it's been observed that shops near in metro terminal, metro stations exits do tend to get higher footfalls. So the businesses prosper, and as a result, their rates and yields are higher than the other parts of the city. Same thing if an airport is coming up or a port is being built, all those things can add a lot of value to your existing investments. You need to invest early if it's a plotted development, partner with developers for land aggregation, and focus on emerging two tier and three tier cities for growth corridors. I mean, major cities like Mumbai, the ticket size is already too high, so that might not be everyone's cup of tea. But you can you can explore two tier, three tier growth corridors. It's an interesting fact that we have over here, friends, that land is the only real estate asset that cannot be manufactured or recreated. Land near upcoming infrastructure can multiply in value even before the project is finished. This is something I have experienced firsthand, friends. In Mumbai, if you've read the papers, a new airport has come up in Panvel, and real estate prices in that area have zoomed up over the last decade. All right, and next we move to REITs, real estate investment trusts. So these are SEBI regulated investment trusts that allow you to invest in commercial real estate with small amounts. The working of a REIT is similar to that of a mutual fund, right? It works exactly like a mutual fund. It gives you access to grade A offices and malls. Low entry size, the minimum investment starts from 500 rupees to 5,000 rupees. Highly liquid because they are traded on exchanges, friends. The typical yield that they provide you is between 6 to 8% plus unit value appreciation. Okay, so yield over here is on the higher side because we are only talking about commercial properties. Remember the first point that we made, that they allow you to invest in offices and malls. So all properties would be commercial. Therefore, the rental yield is on the higher side. If you compare REITs with physical real estate, you will get to know the pros and cons of it. So, physical property gives you higher control, but there is low liquidity, friends. So, by liquidity, we mean how quickly can you sell that asset. Yes, physical properties do have they do have good rental yields. They will give you good appreciation over time as well. But in an emergency, you try to sell a property, you won't be able to do it overnight, friends. It will still require a few weeks time or a few months time to sell it. So that's what we mean by low liquidity. Whereas the REITs are investable by a small amount as well. So the ticket size is quite small and they are highly liquid. REITs are traded on the exchanges, friends. On NSE, BSE, they are traded. So one can directly sell them on the exchange. There's no need for a middleman either. In a physical property, friends, if you're aware, you generally have to hire the services of a broker or a broking agency to find counterparties for you. If you're a buyer, you'll need to hire a broker who will show you around town, show you offices and shops, right? And they are not doing any social service, are they? They will charge you a small percentage of the transaction amount. So in rates, there's no middleman. You are directly selling it on an exchange. The yields are higher and more stable. The properties offers tangible ownership, friends. Remember that. REITs must fact. Now, this is a fact that I really like, that REITs must legally distribute over 90% of their income, which makes them cash flow machines. Okay, this is something I have studied in depth, friends. In India, this distribution has to be made semi annually. Basically, whatever yield they are going to distribute, they have to distribute it at least in two parts. So you don't really have to wait till the end of the 12 months. You can get it either in four parts every quarter, or 6 monthly in two breaks. Okay, so that's the best part, that these companies are not allowed to sit on cash. They have to distribute it to the relevant shareholders or investors. Here we have the comparison. So minimum investment in rates is 500. In a real property, it would be in lakhs of rupees. 30 to 50 lakhs is just a sample size that we've taken. Liquidity wise, yes, you can sell your rates instantly, whereas real property would take at least a few weeks to a few months to sell it off. In rates, you don't really have to take any stress at all. It's a digital asset of yours, so there is no fear of somebody you know, just grabbing it, land grabbing case, no case of land grabbing happening over here. You don't have to worry about repairs or about your tenants not vacating the premise on time or about loans either. So that's a big plus point for an investor in REITs, friends. And return style, you do get regular income. In real property, it would be long term appreciation. In real property, it could be a house, office, whatever it is, but it's your own property. Over here in REITs, you become a part owner, a fractional owner of offices of global giants. Basically, bigger the client, better capable they are of paying you a higher rent. So that matters. Yep. Next, we have fractional digital property investing, meaning co ownership of commercial property through digital platforms where multiple investors share an asset, friends. It has a lower entry ticket than buying entire property, access to premium commercial assets, that's office floors, warehouses, retail, etc. The rental income is shared among investors. There's a transparent dashboard and professional management. And over here, platform reliability is a key factor. Maybe 20 years ago, friends, commercial assets were reserved for the ultra rich. The common man, even the upper middle class, could not dream about owning big commercial assets. But thanks to this concept of REITs and fractional ownership, you can do that. Right. Moving forward, tokenized real estate. So now the technology has evolved and that allows us use the blockchain based digital tokens and become fractional owners of real estate. It allows 24/7 property trading. Well, not as of now in India. As of now in India, the trading happens in REITs in the stock market hours only. Okay, so from 9 to 3:30. But as we expand as an economy, as we become a developed nation, it will become 24/7 in a decade or so. The contracts are smart contracts, they automate payouts. As of now in India, it's early stage technology, but it's rapidly growing. This concept is quite popular and well accepted in UAE, US, Singapore. Risk return comparison, friends. So, residential wise, you will get low yield to medium risk, commercial high yield, but the risk is also medium to high. In land, there's no cash flow, there's high appreciation, whereas REITs, they offer you low risk, stable returns. So, your ultimate dream has to be the upper two ones, owning the upper three, I would say. But then the investment size itself is quite big, right? So for a beginner, a REITs makes more sense because it is giving you good yield, 6 to 8% yields, stable returns as well, and the entry size is very small. So you need to start over here so that few years down the line you'll reach in a position wherein you can afford your residential real estate. Okay. So in real estate investing, the safest assets give stable income while the riskiest ones give the highest growth. So my suggestion is first you understand your own nature, what kind of an investor you are. Are you an aggressive person or are you a moderate type of an risk averse investor? Based on that, you choose your product. Building a portfolio that is balanced, you must combine different property types for stable long term wealth. Like I said earlier, as a beginner, you must focus on REITs, and at a slightly advanced stage, you will move towards residential. At an intermediate level, someone in their late 30s, early 40s, I'm talking from a working professional's point of view, you may start thinking about commercial or fractional ownership. At an advanced level, you can diversify across cities. Plus, you can think about adding land for growth. But in all of these, one must always try to strike a balance between cash flow and appreciation in the assets. Right? If you don't have any other source of income and are nearing retirement, for that sort of a person, I would not recommend that you invest in land because land doesn't give you rental income, right? So they are better suited to either invest in residential or commercial based on their budget size. A diversified portfolio can reduce risk up to 60% while increasing long term returns. Friends. The long term returns are simply undeniable. I mean, every one of us has witnessed how the property rates have gone up. So that's something which nobody argues about. Yep, financing and leveraging strategy. So it means smart borrowing techniques to grow your property portfolio safely. Use home loans for tax benefits. Use LRD for commercial properties. LRD is basically a commercial loan, okay, that you're taking, and ensure rentals that exceed EMI for safe leverage. Well, that's something quite difficult to do. Ensure that rentals exceed EMI for safe leverage. Ideally, it would be such that your rental is covering around 60%, 60 to 65% of your EMI, and the rest you still have to shell out from your own pocket. At least that's what I've managed to do in my portfolio so far. But even that is great help. Remember that you don't have to bother about 60% of that amount of your EMI. That's great because if you're able to contribute more, you can just use that money to prepay that loan, friends. That will save you a lot of interest money. Okay, but do strike a balance. Do not over leverage. People who end up over leveraging, basically taking a loan amount much bigger than what they can finance themselves, basically taking an EMI amount so huge that it starts interfering with their and their families' day-to-day lives. That's over leveraging for you. That will just spoil your balance, friends. So make sure your EMIs are not so large that your routine life gets negatively impacted by it. Okay. Real estate is the only asset where banks willingly fund 70-80% of your purchase. Well, nowadays it goes up to 90%. If all your paperwork is clear, you get funding up to 90% as well. Wealth compounding example. So I have done this calculation, friends, over here, that asset type, if a residential, let's say you get around 4% appreciation, we are talking about prime areas. Okay, imagine that we made an investment of 1 crore in the prime areas of our cities, the best spots. So we are taking the residential rate as the best case scenario. So the rent annual price appreciation 4%, yield, let's have kept it low, let's say 2%, because here I am talking about the final yield, not just the rent that I am collecting, but I will have to deduct the expenses as well, friends. The maintenance that I'll pay, that has to be deducted from the yield. So practically it comes down to 2%, right? So the yield is coming comes down to 2%. Total expected returns that you get is 6%. And over a period of 10 years, your value value of your asset from 1 crore rises to 1.79 crores. That's not bad, right? We are just counting 4% appreciation. It could be more. Commercial property, we are just counting 5% appreciation. The yield is 6 to 7%. Again, I'm discounting the maintenance part, maintenance, the property taxes, all of that. So instead of 9%, which I mentioned earlier, I am counting the yield over here as 6 to 7%. So total expected annual return that you get is 11%. So annual return is a combination of your rental yield plus appreciation. Okay, so in case of a commercial asset, over a period of 10 years, your 1 crore investment reaches to 2.84 crores. Lands, plots, the annual appreciation is quite large, quite more, 8 to 12% range. Rental yield is zero. Your expected annual returns is what basically appreciation you've got. And over a period of 10 years, it's expected to get you 2.59 crores. Yep, and the last one, REITs. So REITs give you 4% NAV growth. The yield that you receive is 5 to 6%. So that gives you total expected annual return at 10%. So an investment in REITs worth 1 crore over a period of 10 years can increase up to 2.59 crores. Okay, this is just a sample calculation I've done, friends. If your asset is near an upcoming infra project, its appreciation might just skyrocket. Yep. So that's it about the different forms of investments that you can do. Now, as far as REITs are concerned, friends, we do have the Embassy Office Park REIT, the Mindspace Business Park REIT, Brookfield India, and Nexus Select Trust, which are listed on NSE as well as BSE. So you can just check their prices online. They just traded as mutual funds, so you will be buying units. Earlier, they were traded in lots of hundreds, but now you can buy single units as well. All right, friends, time for questions. So if you have any questions, LRD is loan. Okay, your commercial loan. It's basically a type of loan wherein you're also factoring in your rental income. It actually stands for lease rental discounting. Yep. Next question, please.
How do I check whether a location is good for future appreciation?
You need to keep reading about the real estate, the infra projects coming up in your city. I mean, I'll take the example of Mumbai. Over the past 4 to 5 years, everyone was basically aware about the metro routes coming up. So far, we just have 3 lines, 4 lines working. Over the next 10 years or so, it is expected that there would be 7 to 8, you know, lines of metros that will function across Mumbai, Thane, Navi Mumbai, right? And the coastal road, I mean, these are not secret announcements, right? They are work. When it gets started, it takes a few years to get completed. So it's not a secret at all, friends. Infrastructure projects are public knowledge. So you just need to be aware. Just keep reading the newspaper. That's it.
There's one more, sir. What are the risks we should check before investing through any digital property platform?
Well, now the risks are very less because it's under the market regulator, okay, and under SEBI, the Securities and Exchange Board of India. So its functioning is just like a mutual fund. You do have a market regulator. The risk would be on the project. For example, let's say I decide to invest in Mindspace Business Park. Okay, they form business parks across India, and they rent out offices to multinational companies. Now, if I have invested in one of those projects of theirs, basically I've bought units of Mindspace Business Park, and due to a slowdown in some foreign country, if these companies shut down, okay, and that rental income stops from there, that is my risk. So that risk will exist in any form, in physical form as well, friends. So that's,
Okay,
I
there's
would
one.
say, economy related risk. Yeah, next question.
There's one more, sir. With so many cities booming in Bangalore, Hyderabad, Pune, how do we
Hmm.
actually know which city will grow the fastest in the next 5 to 10 years?
Yeah, so you see about the business that they are catering to. I mean, what sector has Bangalore been mostly catering to? It's IT, right? Whereas Hyderabad has a lot of pharma as well as IT companies. And then you see their location. Is it a port town? I mean, if you see in India, the cities like Chennai, Mumbai, and Kolkata, they are all ports. So they have multiple sources, or rather multiple sectors that can boom. Their location has an strategic advantage. Whereas a city that is landlocked, we know that it's not really going to do anything related to ports or crude oil or shipments, right? So it's going to focus on other things like auto, pharma, or your IT, like that. So now you see about the potential of these sectors. What is your view on those sectors? Now, every decade, a new sector booms up, friends. Okay, so now in this decade, I believe the sectors that are booming are renewable energy. You have defense, right? And what else do we have, friends? Renewable energy, defense. We have all these pathological labs. We have asset management companies coming up. So these are your sectors that are booming. Now, out of these, which city do you think has an advantage? Which city has the potential to pull in the crowd? That's the city you want to invest in. So read about the existing infrastructure. For example, Pune is the surrounding area of Pune is a manufacturing hub for auto ancillaries. Okay, things like belts, pistons, headlights, all of that gets manufactured in and around Pune. So any major auto related announcement, any foreign company which has to set up a plant, auto related plant in India, is most likely going to target the state of Maharashtra or Tamil Nadu. Okay, because these are auto hubs. They have well established areas for manufacturing. Whereas pharma has been a forte of Gujarat, the area from Baroda, Surat, Ankleshwar, Vapi, Valsad. That entire stretch is full of pharma companies. So if pharma is supposed to boom, then that boom will happen in that sector, that side. Whereas IT has always been Bangalore and Hyderabad based. So you need to do a little research, as in which sector is expected to boom in the upcoming decade. Port cities, there's nothing new about port cities. They've been booming, they've been thriving for hundreds of years now. That's the same story across the globe. You'll find that all the major cities of the world are ports. So they are always going to appear as if they are well developed. So the development now has to go inland. That's what you need to focus on.
There's one more question from Rishabh, sir. What is LRD?
Yeah, I've answered that. What is LRD? We've answered that. LRD is lease rental discounting.
Okay, that's it, sir. Thank you so much, Mr. Karan, for sharing your valuable insights with us today. It was a truly informative session. We would love to have more such sessions with you in the future.
Thank you, friends. I'm looking forward for the same.